What is going on, guys? Nick here, back with another video. So about a year ago I took a look at Ford stock and I tried to answer the question, has the Ford comeback started? Well, if we just look at the stock price, it definitely seems like it has. So I thought since it's been a whole year of the stock rising, now is a good time to take a look at the stock again. So in this video I'm going to show you guys what's been going on with Ford stock over the past year. I'm also going to show you guys why Ford stock is still surprisingly cheap even though it's doubled over the past year. So when I made my last video, Ford stock had been falling for years. The company had been showing no real growth and its product line had become very meh. The company was also buried under billions in debt, and as most expected as the world transitioned to EVs, that the old slow dinosaur car manufacturers were going to just get left behind. But Ford was in the process of transitioning to a new CEO, and this new CEO had some big plans to turn the company around. The first plan was to work towards revamping its product image. Ford dusted off the old Bronco badge and started production on a modern version of the off-roading classic. Ford also began a serious step into electric vehicles after announcing the all-electric Mustang Mach-E and the F-150 Lightning. The F-150 has been a very important vehicle for Ford. The F-Series truck has been consistently one of the best sellers in North America for years, so pulling off the transition of these trucks from gas-powered engines to electric vehicles is obviously really important. Ford started taking reservations for the truck last year, and they've been completely overwhelmed by demand. And as of this November, Ford had to stop taking reservations on the truck after they hit 200,000 orders. They needed to put their focus on making sure that production would actually be able to keep up with demand. The F-150 Lightning is set to roll off the assembly line by spring of 2022. Now, one of the biggest struggles that all automakers have been dealing with is the global chip shortage, which has significantly cut the ability for all auto manufacturers to produce new vehicles. Early this year, Ford announced they would have to cut some of their production because there just wasn't enough chips to keep up with max production. Ford's handled this problem by prioritizing production of its more profitable vehicles and focusing on lowering manufacturing costs. And in turn, this has led Ford to run a much more cost-efficient business. And because this is a global chip shortage that has impacted all automakers, this actually has led to much higher vehicle prices in general, which is driving up prices, increasing profits, and helping to offset some of the production shortage. Ford specifically saw a decline in car and truck sales, but that profit was offset by the SUV and EV sales. Now, by the third quarter in October of 2021, Ford stated that they have seen some improvement in the chip shortage and their production has risen by about 30% from the previous quarter. Now, moving on from the chip shortage, I think the other bigger question that all automakers are dealing with right now is how to handle the transition from gas combustion engines to electric vehicles. Well, in May, Ford announced the Ford Plus plan. The company was going to increase EV investments to more than $30 billion by 2025, and by 2023 they expect 40% of Ford's global vehicle sales to be electric. To do this, Ford has announced two big partnerships. First, they're teaming up with Volkswagen, trading engineering expertise. Ford is going to help Volkswagen build a mid-size pickup truck based off of the Ford Ranger, and Volkswagen will allow Ford to build electric vehicles using Volkswagen's modular electric vehicle platform called the MEB. The other partnership Ford announced just this November is a joint venture with the South Korean battery maker SK Innovation. They plan to spend about $11.4 billion on new US factories, which will produce electric vehicles and batteries, including 2 lithium-ion battery plants in Kentucky, as well as a 3,600-acre campus in Tennessee, which will include SK Innovation's assisting with building a battery plant, along with a battery supply and recycling centers, as well as a new assembly plant for the F-Series trucks, all on the same campus. Okay, so now that we have an idea of what's going on with Ford's business, let's take a look at how they're performing financially. So when we look at the revenue versus net income, we can see why Ford was not really a great stock to buy in the past. While revenue was slowly continuing to rise, each year profits were continuing to shrink. Now, looking just at the revenue, we can see that there was a big drop in 2020, but part of this is due to the drop in car sales during the pandemic. Over the past year, though, Ford has returned to profitability and has shown improvement on revenue. What is pretty interesting is if we look at 2019 versus the 2021 trailing 12 months. 2019 saw $156 billion in revenue, but just $47 million in profits. While the last year has seen only $134 billion in revenue, they've managed to bring in $2.8 billion in profits. And in my opinion, more profit with less revenue is a good sign. When we look at their segments, we can see the overwhelming majority of their business is in North America. Nearly Nearly all of their revenues and all of their profits come from this region. But when we scale up the rest of the segments, we can see that as a whole, Ford has never really performed well outside of the US. The majority of their international markets actually lose money or just barely break even. When we look at revenue versus expenses, we can see why it's been so difficult for Ford to drive up their profit margins. Nearly all of their revenue is eaten up by the cost of revenue, which are the costs to produce and sell their cars. Now, when we move over to the balance sheet, things still aren't great here. They reported $250 billion in assets to $215 billion in liabilities. This leaves them with $36 billion in equity. They reported most recently $144 billion in debt, so this puts their debt to equity in a pretty bad place at nearly 4 times debt to equity. They did report $27 billion in cash, but nearly $50 billion of that debt is due to be paid over the next year. Okay, so now that we have an idea of how Ford's business is performing, let's take a look at what the stock is worth and why I think Ford's stock is still pretty cheap. When we look at the forecasted earnings, we can see that Ford is projected to show pretty considerable revenue growth, with 2023 projecting a record $163 billion in revenue and just under $10 billion in profits. Looking at the revenue growth charted out, we can see an expected 14 and 12% growth for 2022 and 2023. Moving over to their net income growth, we can see that while Ford projects just a 4% increase by 2022, the forecasts see 18% growth by 2023. For the bottom end growth rate for Ford, I'm going to stick with the historical growth rate that I've used to value them for a while, at 3% growth. I think that they will exceed this number, but sometimes earnings multiples are sticky, so I wouldn't be surprised to see the stock trade at this rate in the near future. For the top end of the range, I'm going to stay a little conservative and give them an 8% growth rate. While the turnaround is looking great, I'm discounting a little bit of risk because of the debt situation. A growth rate of 3% gives us a fair PE value of 11, and a growth rate of 8% gives us a fair PE value of 19. When we look at macrotrends.net, we can see that this is roughly where the stock has traded recently, with the stock only recently breaking over this range. So when we look at these PE ratios multiplied by the current earnings forecast charted out, we can see that it is currently priced for a pretty crazy amount of upside by 2023. The stock has a low end potential of 26 per share, which is still a 30% increase from today's price. But if all is going well, I think it should be able to meet closer to the top end of the range at 45 per share fairly easily, which is about 125% upside from today's price. So like I said in the title, Ford stock is still very cheap compared with the current price, even after the big run up we've seen over the past year. Now, me personally, I've owned a leap on Ford for a while, and I just added a whole bunch of shares to my account. Ford's turnaround to me looks a lot like AMD in about 2015 and 2016 when Dr. Lisa Su had taken over. They're revamping an old, stale, and stagnant company into a business that I think people are actually excited for again. Ford has not only talked about promising new plans, but they're actually starting to do a really good job with implementing them, and we can see that in the F-150 Lightning. However, I do want to see Ford work towards decreasing some of that debt, but I do see some of the higher margins from the chip shortage and EV sales, giving them a little extra room to work with. Now, before you go, make sure you guys click this video right here next, and as always, thanks for watching.